Today on the CEO Barbecue, we're looking for copper in BC, Canada, together with Surge Copper. If you want a bullet point summary of this and all the other CEO barbecues in your inbox once a week, go to resourcetalks.com and subscribe to our free newsletter. Now, although the company you're about to hear from has not paid us for the production of this interview, you should still not treat this video as research. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. In any case, please only watch this if you absolutely know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is an extremely tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, and it is also going to contain forward-looking statements. I am not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. Although this company has not paid for the production of this interview, it doesn't mean they won't become a client in the future. They might. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital might be at risk. If you're not 100% sure you understand 100% of the disclaimers I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Surge Copper is listed as Surge without the E, so that's SURG on the TSX Ventures Exchange, where over the last 3 months, the average volume has been about 200,000 shares. The stock's 52-week high is 17 cents and its 52-week low is 9 cents. With a market cap of just under 45 million Canadian dollars and 291 million shares outstanding, today this is a 15-cent stock with a 50 and a 200-day moving average at respectively 11.8 and 11.3 cents, which means the stock is now trading above both of those. About 11% of the company is in the hands of management and the board. Another 11% is owned by Centerra Gold, and 15% is owned by African Rainbow Minerals, and the rest is the effective float, which is almost 2/3 of the company now. Now, as of December, there are no outstanding warrants for Surge, but there are close to 29 million options, RSUs, and DSUs combined, which in total brings the number of fully diluted shares to about 320 million, meaning an increase of about 19% in shares outstanding could occur if all dilutive securities get exercised, which would then result in about a 9% ownership dilution if, and that's always a big if, but if all dilutive securities get exercised. And of course, none of this accounts for potential dilution down the road, which is not unlikely given that this is a pre-revenue company that operates in what is a very capital-intensive industry. Talking about capital, I'll go through their latest financial statement, which shows me the numbers as of December 31st, 2024. So this is almost 6 months ago now. At the time, the company had in total $2.8 million in current assets, the majority of which was in cash to the tune of $2.5 million, whereas the current liabilities side had only about $380,000, mostly in the form of trade and other payables. Moving on to the and there's no long-term debt, of course, but moving on to the P&L for the last reported 9 months, Surge recorded $2.4 million in expenses, but worth pointing out is that a little over $1 million of that expense was share-based payments, and there was also some more amortization included in that $2.4 million. So the effective out-of-pocket cost for the 9-month period was about $1.3 million, or an average of 150,000 Canadian dollars per month. Now, this only includes corporate expenses or administrative expenses, as I call them. And so from that $1.3 million, about 75% of it was management and personnel, consulting, and professional fees combined, whereas marketing, shareholder communications, and travel made up the majority of the rest. The exploration and evaluation expenses here get capitalized, so it's note 6 of the financials that provides more insights into that. And I see a total expenditure for the same 9-month period of $3.4 million, but that includes about $250,000 in BC exploration credit. So really the cost, the out-of-pocket cost was closer to $3.6 million. About 44% of that money was spent on drilling and assaying, combined with geology and field costs being the largest part of the rest. Now, as always, I've got 2 ratios for you here. One of it is the exploration to administration ratio, which was the $3.6 million in exploration to the $1.3 million in administration, which is a ratio of about 2.7. Or in percentage terms, it means that from all the money Surge spent during the last 9-month period, about 73% went toward exploration and evaluation, and thus 27% toward administrative expenses. The second ratio I've got is the drilling to marketing ratio, and that's at about 12, meaning 12 times as much money was spent on exploration as what was spent on marketing. Again, though, I'm not infallible, and this report is about 6 months old now. Expenses may vary from quarter to quarter, so I would encourage you to go to setterplus.ca, look at their financials yourself, and double check and fact check everything that I was saying in here. And also stick around for the latter part of the conversation where I'll be asking Leif about his outlook on the financials as well. Now, enough accounting for the next couple of hours, hopefully, because I've got a brief overview of the company here. And in a nutshell, what most of that exploration money was spent on is the Berg project. Again, it's in BC, West Central BC to be specific. It's about 120 kilometers southwest of Houston and close to the Huckleberry mine. Surge owns 100% of it, and they've got a PEA on it. There's a maiden PEA from about 2 years ago, which I think they want to update soon. But again, we'll talk about that later on. That maiden PEA showed a 30-year open pit operation with about 1 billion tons in M&A, M&I, no, not M&A, maybe M&A. We'll talk about that too. But M&I, which at $4 copper and $15 molybdenum showed a post-tax NPV8 of $2.1 billion, a 20% IRR, and a 4-year payback period. But not without a cost, of course. And the pre-production capex here is estimated at $2 billion, an LOM sustaining capex of $1.5 billion, and another $200 million are earmarked for closure and reclamation. What's notable here, though, is that according to the PEA, about 64% of the projected revenue would come from copper and about 26% from molybdenum. That's why I mentioned the molybdenum price earlier. It was $15. Molybdenum is no longer $15 right now, by the way. There's some silver in here and then a little bit of gold on top of that too, but the moly contents are notably high for these type of deposits. So hopefully we'll get to discuss that later on as well. The company believes there to be upside to these economics, as well as geotechnical drilling last year showed that steeper pit walls are possible, and thus potentially a lower strip ratio might be gotten here with some more upside from the improved metallurgical recoveries, which will also be part of the discussion today. There's also another project that hopefully we'll touch upon later on in the conversation. But for this to actually become a conversation, I might have to consider shutting up and Leif giving you the word here already. But first of all, thank you so much for being here today.
Yeah, likewise. Thank you, Antonio. I've been wanting to do this for a while, so I'm happy we've made it happen.
The pleasure is all mine. And though you and I have indeed spoken before, and I used to follow Search way closer back in, I believe, 2023. This is your first time on the barbecue, so we'll still have to kick it off with the smell test first. But just before we get into it, for the people who listen to my overview here, you've got $2.1 billion NPV, and that's again at $15 moly and $4 copper. So I haven't done the math, so I probably shouldn't say it, but it's probably closer to $3 billion NPV now. But the market only values the company at $45 million. How come? What's wrong? What am I not seeing here?
Yeah, it's a question I spend a crazy amount of time thinking about, to be honest, as you'd expect. And there isn't a good reason, right? It's not like I have there's a bunch of consistent, fundamental feedback from market participants that are, that expose or underlie some kind of, key concern with the project. So, honestly, it's going to be a little bit of my gut feeling based on mosaicing a lot of responses and remarks that people make. And so I'd honestly say that the two things that come up most frequently when I kind of spell it out to folks and I say, hey, look, this is sort of the project that we have outlined and progressed and kind of delivered a bunch of meaningful fundamental catalysts on over the last few years. And hey, you can line this up on an apples to apples comparison basis against a number of other similar companies, whether they're in BC, whether they're in Canada, elsewhere, or globally. And to be clear on that, our peer group is other junior companies that are progressing big porphyry copper development projects, right? So all of these, as you know, and we've got lots of data in our presentation and other kind of materials that point to this, but all of these projects are going to have multi-billion-dollar capex, whether you're talking about pre-production or pre-production plus expansions, what have you. And most of them, if you try to like normalize base case economics to some consistent number, so in some of our analysis, we try to kind of normalize everything to $4 copper, just because that's what our base case was. Many of these things are going to kind of cluster around the low 20% IRR, after-tax IRR numbers at $4 copper. So again, I think we exist in a peer group that you can do apples to apples comparisons against these things, and sort of criticize or have an opinion on what's good and bad about each of them. None of them are perfect. They have different advantages and disadvantages and so forth. But I think Berg and the kind of broader district play that we're advancing, I think it stacks up very well across a bunch of things. And so when I lay that argument out to people, sometimes there's just a bit of apathy to things, especially when you're in that kind of sub $100 million market cap range, let alone sub 50, where folks are just sort of, it's too small. There's sort of, the market hasn't kind of indicated that this is one thing versus another. So take it with a grain of salt. I don't think these are necessarily well refined arguments, but people often sort of shrug and say, low grade, that's number one, or BC. BC is hard, takes a long time to permit. And those are both kind of partially true, but you got to get into the details of it. And I think the case that I try to make to folks is Surge is like it has represented for a long time, and it definitely continues to represent a deep value opportunity on that basis. Like from my vantage point, the fundamental value of the like risk adjusted value of the company has improved over the last 5 years as we've advanced things, de-risked things, et cetera. And that hasn't been reflected in the market value. So, from an investor perspective, there's the price that you pay and the value that you get. And I think the value that you get has gone up tremendously despite the price that you pay, not moving in lockstep with that. And we can kind of get into the details of those two kind of criticisms in a second. But what I'll say at a high level is on the grade side, look, this is a porphyry copper deposit, and like many of these things around the world, it's not just copper. There's like all these things have, for the most part, byproduct, especially if like most of the mine life is coming from a hypogene zone and you're floating concentrates. Most of these things are going to have byproducts of gold, silver, and molybdenum, or all three. And in our case, it is all three, and the biggest credit for us, byproduct credit, is molybdenum. And so when I look at peer groups, when I run my own, I have my own database, of course, of these things. And so when you try to harmonize, even if you take like really high level numbers, like total resource inventories across a bunch of these things, and you calculate them all on a like for like basis using the same metal prices, the Berg deposit is not low grade relative to other things. And I think if the moly credit were in fact a gold credit, we'd be having a very different discussion. And I find that when I talk to some market participants and I'll reference specific peer comparisons, I'm that perspective that I just shared with you is reinforced by people pointing to some of these other ones, saying, oh yeah, there's a huge gold credit there, and a lot of investors are looking for gold. They're looking for gold exposure, and will happily, if they see a copper gold porphyry situation, it's great. You get sort of 2 for 1. In our case, it's copper moly. We do have reasonable precious metal credits, but I think you need to have a bit of a view on moly. And the sales pitch that I'll get into later here is that I think the positioning for us around the moly side of things is a unique differentiator. I think it's a very compelling side to the story. But I don't begrudge a lot of market participants on this, but it goes without saying that a lot of folks don't know what the day-to-day moly price is. They don't know what the sort of production outlook is. A lot of folks don't have a familiarity with end uses for the metal and sort of why it's considered or listed as a critical metal, critical mineral in Canada and elsewhere. So that's an education challenge for us or opportunity. We need to do more of that for sure. And then secondly, on the BC lens, there's a degree of truth to that perception, grounded in historical track records for these things. I mean, you look at something like Blackwater, which is one of the most recently built large-scale mines in BC. Artemis picked it up as a permitted project effectively from New Gold's. New Gold's, I think it might have taken them 10 years or something to bring that project through EA to that point. So there is a track record of these kind of big scale mines in BC of having a longer timeline than most folks would prefer. And what I'll say against that, or as the counterpoint, is I think the strategic landscape for copper is, part of it is about, when can you get stuff into production? And part of it is about, well, if it's a 30, 40, 50-year life project, is it in a safe jurisdiction? And that's a bit of a cliche comment, but it really carries a lot of weight. You have to kind of sit there and think about it, think about where some of the big copper mines that have been built in the last 10, 20 years are, and what sort of experiences they've had that are purely related to the country in which they exist, right? A lot of these things become political footballs, whether you're talking about Mongolia or Panama. A lot of these like huge copper mines have been, the size of the capital investment for the mine. I remember this in the case of OT. It was like 10x the GDP of the country. So like every time Parliament would meet and debate things, the OT football got tossed around, and so that's a risk. It's a risk for sure. And I think when you talk about BC, permitting is a thorough process for sure. But once you're on the back side of it, there's a degree of safety and security that is valuable to the major mining companies who look to make these sorts of investments. And last thing I'll say about that, I've been going on here for a minute, but obviously there's a lot of dialogue happening in Canada right now around this very topic in terms of trying to find a kind of policy pathway forward to accelerate permitting timelines. And it's timely. It's happening right now. There isn't like a concrete sort of foundation to all this stuff yet, but it's happening, and it's happening in the form of both at the provincial level and the federal level across Canada, with a number of bills that are being put forward that are harmonized with the critical minerals strategies that have been outlined or laid out over the last couple of years, to really seek to for projects that meet the right criteria, and that's size, strategic significance in terms of critical mineral outputs, and meeting the right criteria from a permitting perspective, both technical and social. If you can line projects up to meet all those things, if you believe the rhetoric right now, it certainly sounds like there is a political will in Canada to try and improve the overall permitting process, to accelerate these things to, this isn't my words, it's others, 2 to 3 years. So I'm not at all saying Berg is going to be permitted in that time frame, but that is there's discussion happening in BC to try and find a way to make that happen for projects that meet the right criteria.
Well, this opens the door to a lot more conversation. And just for the record, when we Europeans think of that political football, we don't think of it as being tossed around. We think of it as being kicked around. I think that's an important difference to make here, to know that we're talking about the right kind of football. Jokes aside, though, loads to discuss in there indeed. I mean, grade, for sure, I want to talk about it. I want to talk about how molybdenum influences your economics because of how volatile it is. Yes, I also want to talk about permitting, because it is in BC, and capex. I want to talk about it as well. So I hope you've got 2 hours for me, but we'll have to start off somewhere, and we'll start off with the man running the company himself. As I said, we're going to go through the smell test first. So tell me, who are you, and have you made money for shareholders before? Why do you think you're the right man for the job?
Oh, great question. maybe I'll take a meandering approach to answer that. So, look, my background, education-wise, I have a degree in physics from the University of Toronto. At the time that I did that, they didn't necessarily have named degrees in geophysics. It was a research group within the Department of Physics. But I did go down that path. So I have what I would consider to be good formal training in exploration geophysics at the undergraduate level, so to speak. And early on in my career, did some kind of I would call it like research and corporate development type consulting work that leveraged my technical background and sort of gave me pretty strong training in a lot of the technical facets of mining. And that was consulting to buy-side firms, to did a lot of consulting to like nuclear utilities. So it was heavy into the uranium industry in like the 2006 era, which was like the last huge bull market there. So yeah, kind of interesting foray into mining, and but pretty early on in my career, like in the 2 or 3 years into it, I was interested in corporate finance. Full stop. I had a lot of interest in investing, and I was a big reader of Buffett and stuff like this. So I had a love for just corporate finance and how companies work and M&A advisory or M&A transactions in general. And so made a few efforts to find my way into that. Was eventually hired by CIBC in the 2009 timeframe, and worked there for a couple of years as an investment banking analyst at a crazy time in the market. It was like huge M&A deals being done every month and big equity deals being done every second week. It was just a really fun but challenging experience, and still think very highly of that group and a lot of the folks that have come out of that group. I remain friends today with a lot of those guys. And then I made a pivot to a more like ECM focused business, equity capital markets focused business. In the like 2011 timeframe, I moved to London and worked with Stifel. So this was an earlier iteration of Stifel, not the current one that we know, which the current one is basically the GMP Capital business. But at the time I was there, it was the Westwind Capital Partners / TWP platform. So kind of different group of people, but same idea. It was kind of a mid-market firm trying to raise capital for mining companies. And being perched in London, it was really at that time about there was a huge some of the biggest buy side funds working in mining were based there. So there was for a time a really prominent trade of doing equity issuances from Canadian companies with lead orders coming out of London. So got some really good experience on ECM deals and how they all work there. And then the biggest chunk of my career prior to this was I moved back to Canada and joined Macquarie Capital, which is the investment banking division of Macquarie Group, which is a well-known multinational Australian-based financial institution. But not always a household name in Canada, but a household name in mining for sure. Huge pedigree there and fantastic place to spend almost 10 years. I think I was there. And again, always in the corporate finance side of things. So helping corporate clients, i.e. mining company boards and corporate development executives and CEOs and stuff like that, think about how to solve problems and advance their business through raising capital or strategic M&A transactions, whether that was going to go buy a growth project, sell a non-core asset, combine two companies through a merger, things like that, strategic investments. So I developed a lot of expertise during my time there, which I thoroughly enjoyed. And then how did I make the pivot? Well, Macquarie made some changes to their business. All investment banks are constantly evolving beasts, but around the 2019 timeframe, they shrunk the kind of footprint here in Canada in terms of the sales, trading, and research, like cash equities business. So it sort of became a more focused advisory only business, which is great. I stayed for another like year or year and a half or so under that structure, and was involved in some big, high profile, exciting cross border transactions. But ultimately, just stage of life, different priorities. I wanted to. COVID probably had something to do with it, I guess. I wanted to, and family. I had young kids, but I wanted to focus on something where I was more kind of principally involved in it, as opposed to advice to others. I wanted to have more of a significant fingerprint on things, and I was also, and I remain a very big believer in the copper cycle, the copper thematic. A lot of the kind of mega trends at play that are underpinning the investment theses there. And we can get into that. A lot of people have different views on what that all means, but I was excited to get involved with something that had a very distinct copper thematic, and an opportunity arose to take on this opportunity in British Columbia. So home country in Canada. I viewed it then, and I view it now, as a fantastic jurisdiction. And the opportunity at the time was, you could see there was a lot of like consolidation that needed to happen. And so there was I think a good opportunity for me to employ my skill set in terms of deal making and just smart corporate finance decisions to pull together the assets that we needed to make a compelling story, bring some kind of smart, patient capital into things, and so forth. So that's kind of the backstory of me. And I should mention, I did a finance degree along the way as well. So I have a background in physics, but also pretty well trained in finance. Did that at INSEAD several years ago. And then you asked a question like, have I made money for shareholders? This is my first go at being a CEO, so I'm not going to pretend otherwise. But been in the role for 5 years. I think there's I'm very happy with the track record in terms of growth in fundamental valuation metrics on a per share basis. So we've grown resources per share, NAV per share. All these sorts of things that you'd care about. I think we've been very prudent in terms of dilution choices, and we've deployed capital, I think, very efficiently over that time. So now it's really time to push the message with the market and try to get recognition there in terms of the share price. I did join the board of Adventus Mining a few years ago. So the founder and CEO of that company, a gentleman named Christian Cargill Simard, he's sort of my day-to-day business partner. We've had a number of things that we have done together, both kind of Toronto-based ex-banker, entrepreneurial types. So share a lot in common. He's the reason that I took on this role at Surge, and he was appointed as chair of the company in 2021. So yeah, we're partners on Surge for sure. It doesn't take very much of his time though. It's really my I got the controls. And but yeah, I was asked to join the board of Adventus during the last couple years of its path, which was very heavy into looking at transaction alternatives, project finance alternatives. I won't get into the details, but it was, again, needed a lot of heavy duty thinking around stuff like that. And obviously we had a lot of advisors on the case, but I think it was a good opportunity for me to employ those skills as well. And yeah, I mean, that culminated in a successful sale of the company to Silvercorp, which ultimately results in providing the final capital needed to build and construct the Curipamba project and the El Domo mine. So that's a mine that's under construction now, and will deliver a lot of positive economic benefits for all kinds of stakeholders. And it was an all share transaction. So I mean, people have their views on whether that was a depending on what time frames they pick. But it was a transaction that delivered shares in Silvercorp to Adventus shareholders, and I think those have continued to march higher as things have progressed there.
Christian is actually the one who put you and I in touch as well, if I remember correctly. And I actually interviewed him on that deal as well when it happened. Must have been about a year ago now, maybe. So it seems like you, though, Leif, you spend a good chunk of your career essentially helping management teams raise capital. So I'm hoping you can talk to me about how you raise capital for yourself as well later on. But what's the current situation for you? Do you hold any other executive or board positions with other companies?
Nope, not currently. Just Surge at the moment. Yep.
Insider ownership here is noted as 11% of the company. What percentage of that is you personally?
Actually, I don't know in percentage terms, but 5 million shares roughly outright, and then a number of RSUs on top of that. So in terms of just common shares, paid for, I'm the second largest insider owner. So that 11% is, for the most part, close to evenly distributed across all 8 directors and two non-director insiders. There's one of our directors, a gentleman named Pat Glazier, has been a very long time supporter of the company, and he runs a private forestry business in central BC, and so he's been a long time supporter and has, I think, aggregated a roughly 10 million share position in the company. So he's the biggest. I'm the second biggest, and then a lot of the other guys are roughly the same level as me, give or take.
5 million shares, you'd about 2%, I suppose, somewhere between 1.5% and 2%, if I'm not mistaken, of the share on an outstanding basis. How did you get those shares, though? Founder shares, bought in open market financings. How did you get them?
Well, definitely no founder shares, because that's not how the deal came together. And maybe I'll park that and we can come back to that in a second. But open market purchases starting from day one of my job. I should say that in my prior role, I was as a banker. You're not at that firm anyways. You're not allowed to purchase shares in individual companies, let alone in the industry you work in. So I made the move over the Christmas period or the holiday period from 2020 to 2021. So I wasn't really able to start acquiring shares in Surge until I was in the seat. So. But started on day one there, January 2021. Share price was higher at the time for sure. So I acquired a bunch of shares in the market, put some sizable checks from my vantage point, from my personal perspective, into one of the financings we did in 2023, and then to conserve cash at various times over the last couple of years, we've done some what I think is creative but sort of prudent things where a couple key members of management have opted to take annual short-term performance bonuses in shares rather than cash. So that would be the kind of we have a comp committee and there's sort of hey, you guys have hit your KPIs. There's a dollar amount that the board is awarding you as a annual bonus, and rather than taking that in cash, we took it in treasury stock. So it's not an RSU, it's just stock, and that's a taxable event right then and there. And so each individual has to go and pay the whatever your marginal tax rate is on the market value of that stock right at the day. And none of us have ever sold shares on that basis. So it's dollars are fungible. People can think about how they want, but it's equivalent to it's like pre-tax dollars. So it's equivalent to taking after-tax dollars of a much higher amount to acquire the same amount of shares. So kind of a mix of all those things. But I've sort of my personal draw on the company over the last, as long as I've been in the role, the cash component of it has been relatively modest, I would say, because a couple of years I took compensation in stock, and then obviously we have sort of a long-term incentive plan for everyone that involves the dilutive securities you've mentioned, options, RSUs, DSUs, that sort of thing. So, but all the 5 million common shares I referred to are bought in the market in one private placement and then a couple years of compensation as well.
What is the average cost that you've paid for those shares?
So yeah, I'd have to pull up a spreadsheet that I have somewhere tucked away. I would hazard a guess. It's still above where we are. I don't know the exact number, but
right. I don't need an exact number. Essentially,
yeah.
I'm looking for, is it a sub 1 penny stock that we're talking about, or is it something?
No, absolutely not. I mean,
reality.
No, absolutely not. It was yeah, just to give you a flavor on how you make these sorts of decisions. So like, yeah, buying stock in the market, for example, from 60 cents all the way down to, 7 cents, I think is the lowest purchase I've made. We did a financing in 2023 at 13 cents that I wrote for me a big check into. And then, probably a lot of those like bonus things I'm referring to, that was in a market environment where the stock was at, 7, 8 cents, and we didn't want to finance, right? We didn't want to, because you can't go and do a small financing just to round trip that cash into management's for management compensation. I don't think that's the better alternative. So instead we did it this way to limit dilution. And to keep people in their seats and keep people, paid what they've earned. And so, yeah, the effective, I guess, market price of that would have been in that kind of 7 to 8 cent range. So on a weighted average basis, I don't know. It's probably in the teens to low 20s, something like that.
Yeah. Do you plan to be buying in the open market now that the stock is getting kind of in the teens? It's 15 right now. So essentially averaging down. Is that something you're planning on doing?
I mean, it's sort of a personal decision. It has a lot to do with what else is going on in my life with family and stuff like that. So look, I think investors need to think about insider ownership on the basis of aligned incentives, right? Skin in the game and aligned incentives. So I think there's a couple ways to approach that. One is, aggregate ownership size. Two is, how it was acquired, which we've just talked about, and what the kind of, look through kind of cost basis is. And, I think sometimes I see companies talking in a positive way about, hey, the insiders have maxed out their credit cards to buy the stock in the company, as if that is showing the maximum level of commitment. And look, I just find do you really want a board and management team to have a kind of Hail Mary gamblers attitudes to this stuff? I don't think so. I think you want people to have an alignment. You want them to own the same security that is tradable in the market. You don't want people to have a bunch of securities cheap options or something that they didn't pay for, that are fundamentally a different kind of, have different inflection points and introduce different wedges into the capital structure. I've always been the way I think about warrants and dilutive securities in a company is that it introduces wedges into the payoff curve, the payoff profile for different owners of the company, and those wedges will create different incentives and therefore different kind of actions. And I think the fairest thing for a lot of these kind of venture companies to have is straight common shares, obviously no debt, no warrants. Sometimes you need warrants if your investors are demanding it or whatever, but I think we try hard to avoid that. And then the share compensation plan is, these things are all pretty standardized now. It's sort of 10% of the so in your intro you talked about dilution. I think in the case of Surge, we have some options that are way out of the money and rolling off in the next year. So who knows what will happen to those. But we've, I think, evolved our share comp plan over the last couple of years to be very, very simple. Management are paid with RSUs, which are time vested, and they are, the tax. It allows people to optimize a little bit of their tax planning. They don't necessarily have to exercise and create a taxable event if they if they don't want to. You can control over time, but it gives you that long-term exposure, and it's an incentive to stay in the seat. If you quit, you lose all the RSUs. And then for directors, we don't pay our directors in any cash. It's all DSUs. And so, and again, it's not monetizable until they retire from the board, essentially. So I think it's a very, fair and straightforward comp structure that doesn't introduce any of these wedges into the insider group that's going to cause people to do things that are sort of different from how shareholders are approaching things. So as to whether I'm going to buy shares or not in the future, I think there's a ton of value here. It sort of depends on my personal planning with regards to other things in my portfolio, of course. So and if I did, it's not if I go and spend $5,000, $10,000 on surge stock, I don't think people should take that as a big signal one way or another, right? They can take as a signal how we've managed our cap structure and the aggregate size of our insider ownership, and the fact that this is all stuff that people have paid big dollars for out of their pocket or through opportunity cost investment.
I'm shocked. I'm shocked that insiders should have a personal life. I thought that was not supposed to be the case. But you make a good point, and the personal situation does come into play here. And I agree with a lot of what you said, especially the warrants part. I prefer companies with no warrants, of course. You did bring up an interesting point here, Leif, though, about other, the board members, the rest of the team as well. Maybe this is a point where we can move on to talk about them as well, given that you're now moving into the so-called, boring engineering phase, if you will, of the Lassonde curve, where it seems like a lot of the news that you've been publishing as well is related to potentially, and I'm speculating here, but working toward a PFS. And I suspect you'll need to grow and improve your team, or maybe not, but talk to me about your current technical team. Have they worked on and been successful with similar geologies, similar assets before?
Yeah, it's something we're proud of, that we have, I think, a high horsepower but small team. And so each person, it's effectively a 4-person management team. And again, people kind of come to their own conclusions on this about why why different companies have different sort of sizes of rosters. But in our case, look, it's like we have domain expertise, and everyone wears a bunch of hats, right? So in my case, I'm the CEO. Obviously, I really cover everything from high level strategic thinking, recruitment, helping the board to make sound decisions, down into sort of corporate development. So a lot of time spent on thinking about valuation, thinking about how to optimize and improve valuation. So like pretty heavy duty, analytical stuff involved in that, networking, bringing, new prospective investors and strategic partners into the fold. Investor relations is a part of my job. I mean, like, we don't outsource any of that really. So yeah, I wear a bunch of hats. I'll just take you through the list. The other key guy, Shane Ebert, he holds the titles of President and VP Exploration. He was actually the CEO of Surge at the time that I took on the role. And so he has, maybe combined 15-year continuity with Surge and our UTSA project in particular. So we acquired Berg right around the same time that I joined. It was sort of a big part of how that all came together. But yeah, Shane is a well-established porphyry geology expert. He has, to his credit, discovered a couple different porphyry copper deposits, some of which have seen successful exits, to use that word. So he was, in a similar role with Tyler Resources that was acquired by Jinchuan. And one of our key mineral resources within Surge is the West Seal deposit that forms the largest component of the resource base at UTSA, and that was a discovery that Shane has made. And he's well known in the kind of porphyry geology academic circles as well. Spent a bunch of time with the mineral deposit research unit at University of British Columbia. I think in his like postdoc years. So yeah, he's a very accomplished individual in that regard, and takes a bunch of pride in talking about wearing multiple hats. Like Shane and I are both, basically face the board with a lot of, advanced kind of strategic thinking and analysis. But at the same time, he runs the operations at site and doesn't mind, fixing a toilet. He'd probably hate me saying that, but like doing what guys do at camp a lot, which is a jack of all trades and making sure stuff runs and that you're not wasting a huge amount of shareholder money on that type of stuff. So I think we get at least two or three equivalent professionals out of someone like Shane. And then we hired a guy named Mark Wheeler in 2021. So about a year into this, and our like thinking at the time was we had the UTSA project that had a 2016 PEA that was kind of looking at how that project might be integrated with the Huckleberry mine. And then we had just acquired this big resource 25 kilometers away at Berg that had never had any like real advanced economic thinking done on it, let alone by someone with another asset in the district. So we had a really interesting opportunity early on to kind of take a 30,000 foot view of the district and say, what's the right way that this should evolve if like a major owned it, for example. And so we spoke to plenty of people, of course, but ultimately recruited and hired Mark, who started his career at Quebrada Blanca in Chile. So it's Teck's big operation that's now in the QB2 expansion phase. Had some similar operational roles at Barracks Hemlo in Ontario, and then spent a number of years with Treasury Metals in Ontario with one of the prior management group. And so this was really focused on the I'm forgetting the name of the project. I think it's Goliath. Apologies if I got that wrong, but yeah. So the kind of single asset that Treasury had at the time before they combined it with something else. He was one of the lead guys that brought that through feasibility and environmental assessment approval at the federal level, and negotiating and signing impact benefit agreements with First Nations. So again, an individual that has significant experience on both the kind of project engineering, conceptualization, studies, operations, et cetera, and the permitting side of things. So another individual that wears multiple hats. So those three individuals, I mean, I can point you to other junior companies that would have, to cover the same ground, would have, twice the number of people doing a bunch of those things. And yeah, our CFO as well, Chantel Collins, excellent CFO that also, serves quite effectively in the corporate secretary role as well. So I think very, very efficient. But to get to your question about growth, I think we're good for right now. But post PFS, projects like this, when you start entering that EA process and you start talking about, final feasibility, it's of course a bigger stuff starts to get a lot bigger. And it's not just about individual capabilities. It's just about, honoring commitments to different stakeholders, and you start to need more siloed individuals for sure. So I think, looking out 18 to 24 months, depending on where things go, Surge, could certainly be looking for more kind of specific skill sets on the permitting side, and potentially augmenting Mark's team on the kind of feasibility side of things.
Well, permitting is going to be hopefully a big part of our conversation later on as well. But do you or any of the other insiders that you mentioned here personally own a royalty on any of the projects?
God, no. No, I would have
I
a
like that
problem.
answer. I like that you started with. I like that you were almost surprised that I'd ask that question, but
Yeah,
have
no, I would have an issue with that. I know it exists sometimes in the industry, but no. On the topic, I will say that Surge owns a 2% NSR royalty on some non-resource ground at the Blackwater mine. So we are in the same, zip code more or less, postal code, I should say, as Blackwater. And so Surge was early on in parallel with Richfield Ventures at the time that that deposit was being explored and delineated. Surge had some ground in the area and was involved early on. That was ultimately sold to New Gold when they were kind of consolidating everything there. And we retained a 2% NSR there. There's no resources there yet, but in the typical, this is a total detour at the moment. But in the normal way of these things, when a company like Artemis, who are staffed from top to bottom with mine builders. That's all they've been doing since they've created that company 5 years ago is mine building. Now the mine is built, and it's logical that then and only then do you start turning your attention to mine life extensions. Maybe we can find satellite resources that have better grade than the kind of tail end of the mine life, stuff like that. And Stephen and the team there have alluded to some of that, where I think their exploration investment over the last 5 years is like, in terms of greenfield exploration, it's literally close to $0. But they're going to start looking at doing that in the coming years. So again, we have a 2% NSR on some ground in that district that has prospectivity for sure. We'll see what happens, but yeah, that's the only on the topic of royalties. Investors should know that, and then the other thing to know is the Berg deposit has a 1% NSR on it from Royal Gold, just on the kind of claims that host the deposit itself. So it's not like a district-wide blanket royalty. And the impact of that royalty is captured in our PEA economics. There are some other kind of vendor-style royalties elsewhere in the UTSA property package, but most of those have these kind of I'll call it nominal. It's not trivial, but we've got sort of order of magnitude $1 million buyback rights on those royalties. So the way investors can think about that is, if a mine is ever built on some of those resources at UTSA, you would just tack on that to the capex. Like by the time you're making a capital investment decision, you'd want to sort of eliminate those royalties by paying those original vendors the $1 million here, $500,000 there, that kind of thing.
Do you think either of those royalties is buyable or transactable? I mean, could you buy back that royalty from Royal Gold, or could you maybe sell your own royalty that you have on Blackwater?
So on the former, we have no bearing on that, but I highly doubt that Royal Gold would sell this. They just paid, I don't know the dollar amount, but they paid a big number for a comparable size royalty on Cactus. I'm quite sure it was like a month ago, something like that. Which would have a similar cash flow profile to their Berg royalty. So they are. I mean, who knows? But I can't see most of these big royalty companies. They never sell assets, right? They just kind of collect them. So I can't see them ever selling that. In the case of our Blackwater regional royalty, yeah, but not now. There's no resources on it yet. I think we'd want to see some exploration investment happen there, and there's a reasonable prospect that there's going to be some investment by Artemis in exactly that in the next 5 years. So we'll see what happens, but it's not something that we ascribe a lot of value to today, and I don't. I think if we forced a sale through an auction or something like that, it would be it's not gonna move the needle for us in any big way right now. But if something is discovered there, let's see.
I'm already front running a question that I want to ask you later on, which is how do you plan on financing the company and other royalties and so on and so forth. So we'll get to that point for sure. I'm still going through with the smell test, by the way. Do any insiders, board executives, whoever provide services to the company outside of your regular management activities like helicopter, camp, marketing, brokering, anything else, any type of services they're providing?
No, and I think our related party disclosure speaks to this. So no, I mean, most of the management team is under employment contracts, so just standard salaries with payroll deductions, things like that. Our VP exploration, who I talked about before, he structures his affairs through a personal corp, which is common in that profession. So I don't think there's anything unusual there, but that's it. No, there's no directors only provide board of director services and are only compensated through DSUs.
Well, still on the same topic, still within our smelter, still talking about incentives here, because you'll now be moving into, again, the studies part of the journey, if you will. How are you going to measure success is what I'm thinking here, as well as how is executive compensation going to be structured and determined to reflect that? As in what you mentioned earlier, you said certain KPIs are looked into to determine that payout to management. What are those KPIs? What are they going to be tied to?
Yeah, I mean, we have it's not like I have a wide list of benchmarks to compare this against from personal experience, but I think our approach to executive compensation is robust and reasonably sophisticated for the size of company we are. So the board has a compensation committee that on an annual basis discusses at a very deep level, strategy. What are we doing? What is the context of the market that we exist in? Where do we see things heading over the next year from a ability to raise capital perspective to the M&A markets perspective, and what fundamental value driving catalysts can we conceivably execute on in that time frame, and we sort of divide them into different buckets, and these buckets are going to be just high level things like exploration, permitting, or social/environmental engagement, to field operations, to whatever big study we're working on at the time, or whatever's in the kind of 12-month horizon. So and then there's kind of smaller line items underneath that help the compensation committee and the management team track their own performance on achieving these big objectives. And there's a weighting scheme that's put to it. And then at the, on the annual cycle, that kind of weighting matrix, that whole calculation is applied against, agreed terms in our employment contracts and agreements. So, each of us are professionals that exist in a professional market, and we all have opportunity costs. And so a lot of these kind of professional contracts will stipulate, hey, there's a salary, and then there's an opportunity to earn a bonus up to a certain cap amount if you do what your job is well, and so there has to be a framework over ascertaining that. So the KPIs are not arbitrary; they're not the same every year, but they're what you'd expect them to be in terms of how junior mining companies create value. There's nothing new under the sun. We create value by discovering ore deposits, being creative and trying to come up with a economic business model that those ore deposits can sort of move forward in, which is a long way of saying, like, scoping studies and beyond, things like that. How will you finance those things, and what sort of external relationships do you need to achieve, improve, advance, et cetera, to move things forward. So that's how we do it. And I'm not sure, was part of that question, what our forthcoming things are? Or
we'll get to those for sure. What I'm wondering about here is what is the management team or insiders, what are they going to be driven by the most? Is it, we're going to hit a PFS by, I'm just talking on the top of my head, but we're going to hit a PFS by the end of 2026, and that's when a bonus comes in? Or is it, we get our stock above 50 cents and that's when a bonus comes in? What is really the driving force here? What is it tied to? Is it market cap? Is it the stock? Is it fundamental technical stuff? Is it discovery success or something else entirely? That's kind of what I was getting at.
Yeah, it's fundamental stuff. So, if we had share price, there's a few ways to answer this. So everybody is incentivized to have a share price increase because everybody owns and is like primarily only compensated through equity-based securities, right? So So directors are only compensated through equity-based securities, and management, as I went through before, is heavily compensated. Like obviously, people have to be paid salaries in cash, but beyond that, it's very heavy equity-based compensation. And as I took some time to explain the detail of, the equity-based compensation for everyone is just common shares. It's just a linear, everyone is like linearly exposed. We don't have any sort of, non-linear option type payoff curves for anyone. So, so from that perspective, whether it's a KPI or not, everyone is sort of motivated to see a share price increase because of how they're compensated. In terms of the KPIs about, whether your bonus will be 50% of what its target is or 100%, it's more about the fundamental things that we can control. So we can't control the share price directly. I don't turn a dial every day, of course. We do it indirectly through raising awareness, executing on our objectives, and communicating those plainly to the market. But yeah, from a kind of KPI perspective, it is a lot of these kind of big ticket intrinsic value fundamental things. So big milestones, whether it's a resource, an economic study, you obviously know those things are coming more than a year out. You're planning for them. It's a big part of strategic planning. Striking agreements with third parties, certain financing outcomes, things like that.
Leif, talk to me a little bit more about that, a little bit more about insider compensation here specifically, because again, you see it's very heavily equity-based compensation, and it is true. But again, as I mentioned in my overview earlier, there's over $1 million in share-based comp for the 9-month period. And but there's also a cash component, right? So there's $750,000 for management and personnel as an out-of-pocket expense. So for that period, a cash component essentially. That's on the higher end for companies of your size when you combine those two. And it's also grown somewhat between 2023 and 2024, if I'm reading this correctly. So how come, why is it on the higher end? And do you expect that to grow as well?
Yeah, I mean, you might want to take a longer time series of that stuff, because in the case of Surge, we have not just done everything on a rolling calendar basis. It's often been because of the timing of delivering on certain KPIs or even constraints on our share comp plan capacity, which is it's a 10% rolling plan. And when your share price is very low, that kind of impacts your ability to compensate people through that, right? If you're trying to award directors whatever the number is, if you've hired a director on the basis of a annual compensation of $50,000 or whatever it is, and you need to pay them that in shares, and you got a limited number of DSUs, and you have a limited number of DSUs, and your share price is low, it's hard to keep people retained and in the seat. So Surge has had to battle some of those constraints over the last few years, which has resulted in some lumpiness with how we've done it. So from my perspective, it's obviously basically on an annual basis, but it's sometimes things get shifted into the next calendar year versus the prior calendar or fiscal year or whatever, because of when various corporate milestones have been reached. So the last 9-month period that you're looking at might, I think it in fact does have what would ostensibly constitute maybe like 2 years or a year and a half worth of some of these awards. So if you did I would welcome you to do this, kind of extend that time series over the last 5 years, which is effectively when the current board and management team have, recapitalized Surge and kind of created the new push for it. I don't think we'd be an outlier in any of that sense. And if folks have an opinion on, cash salary and whether we're paid more or less than we should, sure, they're welcome to it. But again, we exist in competitive markets for talent. It's sort of our decision on who we want to recruit and retain. And I mentioned before that I think shareholders get a lot of value out of our quite talented management team for the cost that they're paying.
I appreciate that explanation. I recognize the shortcoming in my own term that I've used here, which is a 9-month period. Again, so from 6 months ago. So it'd be good to look at full year numbers as well when they're available, as well as just again, people looking to look into it. The management information circular should be available sometime soon as well for last year, so that might give a better idea as well.
Yeah. Excuse me. I'll mention as well, and I think we detail this in the circular. So the comp committee that we have is, it's staffed by serious professionals who've done exactly that role. For the chair of our comp committee is a gentleman named Richard Coulter-John, who has played that role for a number of well regarded successful junior mining companies. He is very sophisticated at it, very honest, highly ethical guy, and brings a lot of respect and kind of dignity to the whole thing. And so, yeah, it's not picked out of thin air. There's a lot of thought that goes into this stuff, and there's a lot of benchmarking. So when you're sort of referring to some stats about how we would compare to others, we do our own benchmarking. It's very thorough. We sort of track a long list of who we regard as our who we're competing for capital with, who we have a lot of overlap with in terms of stakeholders and investors, and we are making sure that we're in line with that peer group, which is the right way to think about it. It's like the people that you try to recruit, retain, and staff a company with, they can walk away at any time to go to any of these other companies. It's a competitive market for talent, right?
For sure. And I recognize that. It's interesting to talk about that as well. I think we could do a whole podcast on it in and of itself. But this sounds like there's been enough smelling here. That's enough of a smell test, I think. Let's talk a little bit about the history of the asset here. You mentioned that you might want to go a little bit more in depth on it, but relatively big asset. You say it's close to infrastructure. It's in BC. How come you have it? How come nobody beat you to it? How'd you get your hands on it?
Yeah, it's a great question, and I think it speaks to the kind of excitement that I had taking on the role, and and others that we've managed to recruit to the company. Some of the directors I've talked about. So I'll give you some historical context. I'll give you the short context first, like what's happened in the last few years, and then I'll give you a bit of a longer context for kind of how that came to be. So, rewind to mid 2020, so middle of COVID. I don't know, from my vantage point, others may have a different view of history, but as a banker at that time that was, intimately involved in raising money for companies in the Canadian market, I can tell you that, sitting there in June 2020, I don't think there was a copper junior bought deal or financing of any sort for the 5 to 10 years prior. There just wasn't. I mean, that's maybe too extreme of a statement, but there was no copper junior ecosystem at that time. It was sort of a subsector that was had been out of favor for a while. Most of the market was gold all the time, and there was kind of some special situations around the edges. I think in 2020 there was a new narrative forming around copper that has now been, it's consensus and it's familiar to most people. We don't need to go into it, but this is just energy transition related thematic and the role that that's going to play on copper. Robert Friedland, to his credit, was banging the table on this, and in fact is probably responsible for a lot of the lexicon used in the copper world. I think he recognized early on in his sort of revenge of the miners type stuff that this was a real fundamental investment opportunity that was forming. And and so we the idea that the insiders of Surge, or the people who are now the insiders of Surge had at the time was, look, let's look at let's look at a list of, let's do a top-down screening exercise on known resources in a few different places. But like, BC was obviously on the list. And the situation around what is now Surge just jumped out to us because you can kind of plot these things on a map, and you could have seen in mid 2020 that listed company Surge had a nice resource at UTSA. This Berg project that Centerra owned, and I'll get to the longer history there, had also a compelling resource not too far away. And then there's like reserves in place at the Huckleberry mine that everyone kind of knew was on care and maintenance. So it's like you have a sort of cluster of stuff that kind of looks like it should go together to some degree. And so that was the back of the napkin opportunity. And so we got to work. We approached some of the folks at Surge at the time. The company was a little bit in cash conservation mode because, as I mentioned, there wasn't really a healthy market for these sorts of juniors for the several years prior. So Shane, as I said, he was a CEO before. He'd done a phenomenal job. I think he's a very smart guy and great steward of these things. He'd done a phenomenal job of staking ground, getting a lot of smart geology done efficiently at low cost, and keeping everything in a really good position. So there was no kind of option payments that needed to be made to keep the land package together. And, through notices of work and things like that, the kind of status of the claims was all like kind of way pushed out. So the operating, like the carrying costs of Surge at that time, like to just run the thing, was very low. And so it was in this kind of, hiatus mode. So we approached the company and said, we would like to inject some capital, add some people to the mix, and see if we can get a deal done on Berg and go forward. There's a interesting consolidation play here, and they were the folks were completely amenable to that. There was a through the front door type thing. There was no need for proxy contests or anything like that. And in fact, so I came on as the CEO with all of the incumbent directors, and through like a slow but agreed to process with everyone. There was kind of methodical, incremental refreshing of the board over time, and most of the management kind of stayed in place. So it was a very interesting way to sort of kind of refresh a junior. A lot of times when that happens in this business, it's like there's a degree of hostility to it where a new team comes in, does like a massively dilutive financing, everyone gets turned over. It's like a very disruptive thing. I think we didn't do that with Surge, and really in parallel with that, we approached Centerra and said, "This is our plan. We're not just some nobody from down the street wanting to pick up a copper asset and have a punt at it. We're a relevant counterparty because we operate in the same district. Like we have relationships with the First Nations here. We know how to invest. We know how to run camps here. We're the right guys to do this." And so we entered into an agreement with them in December 2020 for that. So then your question, how do we get it? So I think the longer story is helpful, and I don't want to speak for Centerra, obviously. I can't, and I don't want to speak out of turn on that. But my kind of opinion on it, just mosaicing things. So the history of the Berg deposit, it was effectively discovered by Kennecott, like at the same time as a lot of these types of deposits were in the world after the porphyry copper deposit model was developed. As part of that kind of academic unlock, geoscientists, learned a lot about alteration signatures, what they look like. And there was, this is way before my time, but as I understand it, a lot of the professionals in the business at this time were literally flying planes up and down the Andes and the North American Cordillera and stuff like this, saying, that might be one, that might be one, that might be one, based on these like big, color alteration anomalies, stuff like that. And Berg is like that. You can literally see it from space. So it was originally, discovered by Kennecott in that fashion. Not too long after that, it ended up with Placer Dome. who did a significant amount of drilling at the project. It was, I think, a lot of people from the Placer days have fond memories of the project as being, an attractive one from that era. And then, in the when Placer Dome was taken over, there's a couple other sort of transactions around that, and a bunch of the BC porphyry deposits that had originated from that portfolio ended up in a junior company called Terrain Minerals. And so that was like Berg and Mount Milligan were kind of the key ones. And Terrain, this was in a much more robust market environment, kind of the super cycle in the 2006 to 10 timeframe. Really advanced these projects, and Mount Milligan was number one for them, and I think Berg was 2 or 3 basically. So they were, hard charging on unlocking metallurgy and all that stuff at Mount Milligan, and brought that all the way to like final feasibility study and permitting and stuff like that. And Berg was just sort of like behind it in sequence. It was just like it wasn't the key asset, and a junior always has to prioritize things, right? So they weren't. They were doing really good work at Berg, drilled a lot, did a bunch of met programs, but as it's been explained to me from some of the Terrain guys from that time, the approach to the met programs were like piggybacking on what was being done at Mount Milligan. So they had big met programs going on at a much more advanced project, and the brain trust was focused on how to like figure out the copper gold, recoveries at Mount Milligan. And then kind of while they had that program going, while they had the attention of some metallurgists at the lab, they said, oh, here's a few tons of stuff from Berg as well, kind of like, spin up a similar program. But of course, it's a different deposit, it's different metals, it's different mineralogy, everything's different, right? So these things are all snowflakes. And so you need to have the brain trust on each of these things to really make progress. And so that was sort of, I think Terrain did a bunch of good work. And then, as things go, they kind of got over the finish line at Mount Milligan in terms of, feasibility study and, permitting advancing enough that a company called Thompson Creek Metals wanted to acquire them. And so Thompson Creek acquired Terrain, and their goal with that acquisition was to build Mount Milligan. And so they, again, super cycle. They did like $1 billion in high yield debt issuances in the States to plus a gold stream on the project to finance its capex, and off they went. Elsewhere in their business, it was a moly company. I think a lot of people maybe remember this. Thompson Creek operated a couple primary moly mines. One of them, its namesake, the Thompson Creek moly mine in Idaho. The other one, the Endako moly mine in not too far from us in BC, and they also owned a roaster in Pennsylvania called Langloth. So a very unique company in terms of its profile. There wasn't a lot like it, and fast forward a few years, they got into financial trouble. Just distress, right? And I'm not saying anything out of turn here. It was just like the debt to equity ratio in terms of book value of debt to the market value of their equity was like at least 10x. I'm not sure where it was, but there was there was a bunch of high yield notes that traded in the market. They traded way down to 60 cents on the dollar kind of thing. A bunch of hedge funds I remember were involved in purchasing those. Eventually they didn't go bankrupt, of course, because they had a bunch of operating assets. I think these things often work out this way in mining. They found a buyer. I think there was a strategic process they undertook, and Centerra ultimately, came to the table and did a very big transaction to acquire Thompson Creek. And again, I'm expressing my opinion here, but I think some of the unique circumstances around why Centerra bought that business was less to do with, I don't think Centerra was interested in a bunch of moly mines. It was really about they wanted to diversify their cash generating ability away from Kyrgyzstan to basically anywhere else, but the better jurisdiction it could be. the better for them. And at the time, the state company in Kyrgyzstan owned not a controlling stake, but a very impactful stake. I think it was like 27% or something. So they were, limited in their ability to go and do big equity mergers. Like they would face the risk of having a transaction voted down if they went and tried to do a 50-50 merger with some other mid-tier gold company. So I think that was part of the strategy that they were focused on at the time, was how do we buy something that basically has a huge debt stack. Like there's an asset value there that we can buy without having to issue a bunch of shares, or like it has kind of a unique financing angle to it. And Thompson Creek presented that opportunity. There was a small stub equity that they had to buy. And the rest of the transaction basically came through just agreements with the debt holders, just kind of, turning over that high yield debt. And I think they restructured the stream from a gold stream to a copper stream, and away they went. So Centerra, in the aftermath of that, they did this transaction on Thompson Creek almost again, I'm not speaking for them, but I think most of the motivation was Mount Milligan and the cash flows that came out of copper gold mine in BC. And all this molybdenum stuff kind of came for the ride. And it hasn't been until recently that they are, trying to sharpen the pencil on what can we make of this moly stuff. And now they're talking about restarting Thompson Creek and what to do with all that. And Berg is not Thompson Creek. Berg is not a moly mine. It's not like Endako or these other things. But I think it's fair to say it kind of got lost in the mix there. It was a earlier stage. There was a resource on there with like pretty decent numbers. Like I think when we bought it, the compliant resource that Centerra had on their books was like 600 million tons at 0.45% copper equivalent. And I think people had some kind of like mixed memories about it from the different owners. But it's just one of these things that I think had sat on the books of both Thompson Creek and Centerra for a long time, like almost 20 years, maybe less, 15 years, without any real work being done on it and without the brain trust being on it. It's like everyone talks about in mining about non-core assets getting not getting the A team put on it. And well, that's what happens. Like value is not uncovered. Value is created in junior mining a lot by just that simple thing. You can buy something, or you can take on something from another big company where it's maybe just not enough is known about it, but it's really just applying heavy duty, creative, smart thinking to a problem, and bam, you can unlock stuff. So when long-winded answer, but you asked, how did we get it? That's how we identified the opportunity as being, placed in the context of a established mining district in BC with a listed vehicle that owned important resources in the district, and a owner of Berg that it was non-core. They weren't investing in it, is the simple answer. And it's always better for situations like that for a focused team to approach the owner and say, like, putting aside the terms of the deal, like value isn't accruing to this right now. If we can go and raise new money and apply our minds to it, we can create value for the that will accrue to everyone, right? And that was a simple pitch that sort of, I think, was effective with Centerra at the time. And they remain, for what it's worth, they haven't sold a single share. We originally did a 70% earn-in deal. This is a bit of a detour, but it's relevant to the discussion. So the original deal was we were going to invest $8 million into the project over 5 years and pay them $5 million worth of surge stock. The stock payment stuff happened straight away for the most part. And then the $8 million was effectively deployed over 3 years rather than 5. So 3 years later in 2024, or like Christmas 2023, we had approached them and said, we're ready to vest. We're ready to form a JV. Happy to do so. Alternatively, we think we would like to own 100% of this. And we think that, everyone will benefit from that, because having consolidated ownership here is better for Surge. It allows us to attract, more kind of copper oriented partners to the mix. And, we would like to move you into the top co. So take you out of your JV position and give you a much bigger position in the public company and ride with us to the, several milestones down the road. Who knows what happens, but obviously if we're successful in, bringing this to attracting significant partners to the mix, Centerra can monetize their stake in a much more efficient way than being a non-operating 30% joint venture partner.
I think this answer was longer than most of the junior mining interviews as a whole out there.
Sorry.
I actually like. Absolutely nothing to apologize for. I should thank you for it because I do like these in-depth conversations. I don't think they happen anywhere. I don't even think they happen at conferences. I've been to a couple of conferences over the last 12 to call it 18 months or something like that. And those meetings are like 30 minutes, rapid fire type of thing. You don't learn stuff like that you're telling me here basically anywhere else. So I really appreciate you putting this time and going as much in depth on it. And this might actually be a good point to, or a good segue into talking specifically about the business plan here, because again, you've got your hands on a rather big asset now, but it's also got a rather big price tag on it to build, right? To $2 billion, or at least it was in 2023. So what's the game plan for Surge here? Trying to build it yourself, or are you going to be looking for a takeout sometime soon, a JV? How do you see the future?
Yeah, so this is this will be another long answer, and I apologize, but I think it's important, and it's part of again what's attracted me to the role. And so there's a couple, I think, framing things to say about this. So one is I think a lot of investors in junior mining, understandably, like depending on their background, not everyone has the same perspective as me. I have a lot of M&A experience in mining. I know that these types of assets can trade hands many times at attractive price points well before they get to cash flow. So I have zero discomfort with the idea that that these types of assets can be priced efficiently in a market over time. I don't think that's the environment we're in right now by a long shot, but in terms of a business model of how we deliver value to our shareholders, I come from a background that gives me a lot of confidence and comfort that these sorts of project concepts, advanced resources, pathway to development, these things can become very valuable to a broad marketplace of mining industry participants. But I know that a lot of investors in junior mining, whether they come from different sectors or, maybe they run small to medium sized, cash flow dominant businesses as opposed to sort of like, asset value, trading asset value type stuff. A lot of people have this totally understandable perspective, which is, hey, you're not generating revenue now. How will you get to that point to do so? And you're proposing a project that seems to be not in concordance with your balance sheet. So like, help me kind of square the circle. And so now I'm going to get into the long part of the answer. So I think Surge actually has a couple different features to it that help people understand that. So on the kind of Berg side of things, so Berg is our flagship asset. If you look at our disclosure, a lot of it kind of parks UTSA to the side. It's just sort of what's the resource inventory at Berg? What's the NPV? What's it's very, very Berg focused. And from that perspective, we exist in a marketplace of peer companies where there's actually a lot of apples to apples comparison that you can do. Like Berg is in a lot of ways, it's a typical porphyry copper deposit. There's lots of these things out there. Lots of them are being, explored right now. There's been a few notable transactions for these things in recent, in the last year or so. Not many, but a couple pretty high profile ones. And so, yeah, we exist in a marketplace where investors can kind of say, all right, so this is a 30-year mine life, and at $4 copper, with all of the caveats that come with a PEA in terms of error ranges and stuff like that, you're saying that it sort of equates to a $2.1 billion NPV and a 20% IRR after tax. Okay, interesting. How much metal comes out of that thing over the life of mine? okay, 6 billion pounds copper equivalent over 30 years. Okay, those are the sort of fundamental metrics, and you can compare and contrast that to a bunch of other projects. So it stands to reason that all of these projects and all the companies that are pushing these things forward will, to a degree, have the same that same question that you're asking. Like they'll have to contend with it. I don't mean like how they answer the question to investors. I mean like how they think about it as a board. Like are we in the business of actually going to, cross the Rubicon of entering construction on a large scale 100,000 ton per day mine, and like what does that entail? And different companies have different approaches to it. Like I think the Augusta group is notable. So Richard Wark and team. So obviously they're pursuing or pushing Solaris resources right now with the Warintza project, but they are, I think, well known for their big success story at Rosemont. So what is now referred to as Copper Worlds in Hudbay's portfolio, and they have a few of these exits, right? So they Ventana was their first, and then Augusta, Rosemont, and then Arizona Metals, the sort of Taylor zinc discovery in Arizona. Arizona Mining, I can't remember what it was called, but yeah, so they have a few of these things, and so high profile, like really well followed team in terms of like capital markets backing, and like their answer to that question is like straight to the point. We won't build a mine. We're not mine builders. We're in the business of de-risking these things and selling them. And oh look, we've done it 4 times here already and created billions of dollars of value for our shareholders. So they have the luxury and benefit of that kind of history. But again, like you look at all these sort of things, I think investors, it's totally fine if you're investing in the gold mining business, that industry has a little bit like well, I don't want to complicate things. You can focus on small mines that have lower capex and can be funded through the capital markets, or you can focus on big mines that it's just explicitly more of like a corporate partnership M&A type thing. And maybe that's not for some people. Maybe some investors want to feel like they are backing a management team that has a clear, doesn't rely on anyone else other than the capital markets, and is going to like go it alone and sort of, convert this into a cash flowing enterprise. And that can work great sometimes. I've seen as a banker with a lot of experience in these things, I know it doesn't always work well because there's a lot of different skill sets at play and different, it's very hard to transmute a junior mining company that's focused on drilling holes and thinking of project concepts and de-risking to and permitting. Like that's what junior mining is good at. Major mining is good at building mines and employing thousands of people to accomplish the task. They're just sort of fundamentally different things. So in the case of Berg, I think I am maybe more explicit about this than some of my peers. Like I view it as an M&A sort of situation. Like we are trying to advance a project that is obviously solid and delivers what the ore body can deliver, like maximizes the ore body's potential in terms of financial returns. But we're not shying away from the size. Like we're not trying to completely not deliver what the ore body can do so that we target some arbitrary thing like some pre-production capex number under some amount, because we assume that if this project is going to attract the capital required to build it at the end of the day, most of that capital is going to come from a corporate balance sheet. That is just like what porphyry copper is about. And you can see these examples in things like, Filo, for example, right? Like the Lundin organization, if anyone can, bring a junior to the production stage level for a big project, of course, they'd be top of that list, right? but it's a huge project. Like they need a balance sheet, right? And they can raise huge amounts of capital in the capital markets, but it might not be enough for something like this. So they need a corporate balance sheet. And I think um, I think that's a safe kind of first order assumption that you can make about porphyry copper in general. So whether you're talking about any of our peers, if they're talking about a multi-billion dollar 20, 30-year mine life, type thing that produces 100,000 tons per annum of copper equivalent, no one is thinking that they're gonna, put this thing into production themselves with a few bought deals and a project finance facility. Like it's just not. I mean, the world could change in the next 5 years for sure, but that's not the status of things today. So I think that's half of my answer. The other half relates to UTSA. So, and I think this is a really unique thing that we don't pound the table on. It's not prominent in our disclosure, but I think it's worth investors understanding a little bit. So we own this project called UTSA. It was really the foundation of the company Surge before we acquired the Berg project. And UTSA refers to a couple different deposits, each called Seal and Ox, that are positioned about 5 kilometers to the southeast of the Huckleberry mine. And this is not a big secret. It's pretty obvious, but like we just believe that and UTSA very well has a perfectly fine go it alone, standalone economic model. Like we could produce a PEA for UTSA that I'm sure would be fine. I don't think it would be as I don't think it would hit the same metrics as Berg, and it wouldn't make sense for us as a company to have 2 very similar projects that aren't really integrated with one another, that are like competing for capital in that way. So again, third parties may run the ruler over UTSA and say, well, this thing is interesting. It can easily work on its own. But from our vantage point, like the most torquey value creation opportunity for our UTSA project has something to do with the Huckleberry mine. So the Huckleberry mine, we don't own it. We have no interest in it. No like current agreement or anything like that in it. It's owned 100% by Imperial Metals. I of course don't speak for them. But just the status of it, it's been on care and maintenance since 2016. In 2016, copper prices were in the low $2 range, and that company was still, dealing with the aftermath of the tailings incident at Mount Poly, and I think they just had limited capacity to sort of weather all these things. They were carrying a large debt load from building Red Chris, et cetera, and so that was the circumstances under which Huckleberry was placed on care and maintenance. Fast forward all these years, they ultimately brought in Newcrest as a 70% joint venture partner at Red Chris. Achieved a very attractive sale price for that transaction. They were able to deleverage the balance sheet in doing that. That mine still operating, of course, in the open pit. And now the other joint venture piece is owned by Newmont, who acquired Newcrest, and they're approaching final feasibility study for a block cave expansion there, and it's been listed or talked about in the news as being a priority project to be accelerated through the EA process. So I think it's fair to assume or fair to think that big project is going to kind of get the green light at some point here in the next while. And so Imperial they have bigger fish to fry than Huckleberry right now. They're trying to advance their 30% interest in this world-class, copper gold's mine at Red Chris. And meanwhile, they restarted Mount Poly, which had quite apart from the tailings thing. The tailings thing, I think, has been to their credit, like really well dealt with. They brought it back into production in that sort of 2016 timeframe after the tailings breach, and then it in turn was placed on care and maintenance, unrelated to that. I think just because of copper prices and just economic considerations. And when copper prices strengthened again in 2021. they brought it back online. And so that mine is now performing very well at its like kind of nominal run rate, producing free cash flow, looks very good. Some fantastic exploration results coming out of that. So all that is to say is I think Imperial have, the future is bright for them. They have some important corporate finance, decisions to make. And Huckleberry just kind of gets lost in the mix for them. I told you my long story relating to Berg about how to think about non-core assets. I think it's fair to say Huckleberry is a similar situation. It's I think right now it's maybe not core to Huckleberry or to Imperial. Maybe it could become more of a core asset in the future, depending on what happens and how things go. But I believe that, so the key thing to know about that mine is they report today reserves of about 35 million tons, which is, that would translate into maybe 6 years plus or minus of mine life at the kind of nominal throughput. There are some additional resources there. It's a question of, whether those can be converted into reserves. We have our view on it. But suffice to say, I think there's a very, very coherent, like straightforward business case to be made that the deposits that comprise UTSA, not all of the resources there. We have like 500 million tons of resources there. You don't need all that. Just like whatever the best 50 to 100 million tons are there, that is low strip ratio, high grade, whatever, like the best stuff there, that can be integrated into Huckleberry to extend the operating life of that infrastructure. And, we just think that is like logical. It creates value for everyone. And so we're interested in seeing that happen eventually. And I don't expect investors to understand the minutia and kind of vagaries of how M&A transactions work. But what I'll say is that, you can't force an M&A transaction whenever you want. It's like, they're kind of like dances, and they just sort of, they align when the circumstances for everybody aligns. It's like, it takes two to tango, right? So you can have like a super logical transaction that you have a high degree of confidence will make sense to happen one day. But that doesn't mean that one party can just sort of make it happen, no matter how good they are at selling, being a salesperson or whatever. It takes an alignment of circumstances for everyone for there to be a right time to do stuff. And so my opinion is that that's kind of that's the case in this situation, is that right now they're holding that asset on care and maintenance. They spend $8 million a year roughly to do so. So they're preserving the optionality for themselves to restart that. Eventually, there's reserves left there. There's value left there. Eventually, someone is going to have to make, or will want to make an investment decision to restart that mine. They would be the first in line to do that, of course, but maybe they choose not to. Maybe they want to solicit a third party to do so. And I think there would be, lots of folks that would take a serious look at that. Again, long answer, but I think Surge, the very simple point I want to make is that because of the resources that we own at UTSA and the work that we've done on this kind of general concept, I think we're in a very strong position to capture economic value from the Huckleberry mine's future in some way. So from that mine being restarted, it would, and to add one more bit of flavor to this, when any mining company, or like when an analyst is looking at the prospect of mine capex, if it costs, I'm just using round numbers here, just whatever. If it costs X dollars to start a mine, and that mine has 10 years of mine life, that is just fundamentally riskier than the same investment with 20 years of mine life, right? We don't know what metal prices are going to do, and all else equal, a longer mine life gives you more time to ride the kind of stochastic curves, the stochastic variability of metal prices to ultimately achieve your kind of full cycle long-term returns on capital. So you can have a feasibility study for a 5-year mine that says, oh, I'm going to achieve, 50% returns on capital. But if like, again, 5-year mine life, if literally one of those 5 years you get the commodity price completely wrong, that can dramatically impact your expected, life of mine economic returns. Whereas same situation, 20-year mine life, you get 1 year wrong, it's not as big of an impact, right? So it dramatically lowers the risk of a mine investment if you have a longer mine life, like straight up. So I think our perspective is that whenever investment is being made into the restart of that mine, we're open to, we want to have conversations with them about it. And I think we've been, honest with them or straightforward with them about that we're keen to explore opportunities to create value for everyone. In the meantime, we're not prioritizing a lot of investment there. It's a advanced resource. Like if you look at the resource disclosure for UTSA, the percentage of it that's in the measured and indicated category is quite large. The proportion of that resource that we think would be relevant to this business case that I just talked about, the integration into Huckleberry, it's much less than the total M&I resources today. It's only the kind of pockets at surface. So that stuff is well drilled off. A lot of metallurgy done on it already. So yeah, from a surge perspective, we view that whole situation as being a really compelling option that we are able to hold on to for very little cost. We're not spending a lot. We don't have to spend a lot of money to be advancing that. It's sort of waiting for external circumstances to align. And in the meantime, we are advancing this very exciting project at Berg that we think stands head and shoulders in line or above a lot of its peers. So all that was an answer to your question, like what's our business model? So it could be both, right? I think if that mine is to be restarted in the next couple of years, and there's an opportunity for us to be involved in that, I think we're absolutely game for it. And the quantum of capital there is totally different than what I talked about at Berg. It's not one of these billion-dollar situations that needs corporate balance sheets. It's like an order of magnitude smaller, and thus, for sure, can be. I think there's lots of opportunities to fund that as a small company through a mix of project finance, offtake finance, equity, those sorts of things. So I think there's. Investors should view Surge as like a district play. There's a care and maintenance mine in the middle that its owner hasn't really decided what to do with yet, which is fine. They got other fish to fry at the moment, and we're trying to advance the other big resources in the district with a view that if all this stuff was under one umbrella, I mean, it could rival Highland Valley, right? It could have the same output and mine life and longevity and cash generating capability as Highland Valley. And indeed, that's Highland Valley's history, right? It's not a single thing. It's like an amalgamation of a bunch of stuff.
Yeah. Well, again, loads to touch upon there. I think this answer too, I'm just looking at the clock over there, was longer than most interviews out there. So you're providing more value than I bargained for. So I'm happy for that. Before I move on with the questions, how much time do you still have for me, just so I know which questions to go through?
20 minutes.
Let's do that. Okay, good. That's good. I think we're gonna have to follow up with another interview at some point later down the road, though, because there's a lot to talk about here.
Yeah. This is good though, because I don't want to look, me rattling off the headline numbers from a PEA is not. I've done that elsewhere, and people can just read that. I think this is more, nuanced. It's an opportunity for me to shed light on how we think about strategy and stuff.
Well, I'm just happy that you're not here, talking about blue sky potential and elephant countries and having 10x potential and stuff like that, because that's what happens a lot of the times in these interviews. And this is, again, I really do appreciate it. But how much money do you have right now?
$1.5 million, give or take. So the simple answer for that is where you're going with this, I assume, when we raised money last year. There was a strategic investment that was made. It's an important thing people should know, and I haven't brought it up on this interview yet. But we brought on a South African mining company called African Rainbow Minerals, or ARM, as a 15% shareholder last year as part of a multi-tranche investment or multi-tranche financing that totaled around $7.5 million. And the messaging on use of proceeds from that event was runway till the end of 2025, and delivery of the technical work programs that will underlie pre-feasibility study. So we've delivered a bunch of that stuff. If you look at the recent press releases over the last year, it's a mix of drilling and some kind of laboratory-based engineering work. So yeah, we are in a comfortable position from a kind of corporate perspective. If for whatever reason we needed to slow down, I don't see that. It's not like a base case, obviously, but there's obviously stuff happening in the world that could impact our capital markets. But so the company's in a comfortable position there from like a runway perspective. But as we finalize the kind of planning around our field season this year, there's a few items moving around that will impact total meterage. So we're basically embarking on one of the last drill programs that we'll have before crystallizing a resource block model that will feed into the pre-feasibility study. So we're doing some. It's a final opportunity for us to target certain areas of the resource that have inferred blocks in them, and to look to convert those. Obviously, for a resource at this stage, a lot of the remaining inferred blocks are going to be like low-grade portions of the resource. That's why they haven't been drilled. And so there's kind of, it's not clear cut whether that's a optimal use of capital to poke a bunch of holes into some deep, marginal grade inferred resource. So we need to have a bit of a quantitative understanding on that, and so that the kind of total numberage of or the total meterage for the program is still being refined. So yeah, we will be looking to undertake a financing transaction before the field season gets fully underway, which is later this summer. And but yeah, have a great shareholder register, including ARM, as I've mentioned, and some other notable supporters that are there to support. So yeah, we're in a good spot.
What are you thinking in terms of conversion here, though? I mean, you've got 1 billion tons in M&I. I was going to say M&A again, but it's M&I, and another 542 million tons in inferred. How much of that would you realistically like to see cross it over to proven and probable?
Yeah, so the right way to think about it is not so much those aggregate numbers. It's the percent. So the resource is always pit constrained, and you got to use the terminology from 43-101. It's like the eventual prospect of extraction, and so there's sound economic reasons why aggregate resources use a lower cutoff grade than reserve cutoff grades, and the reason for it is, if a mine was built and a huge amount of material was extracted 30 years down the road, is there a possibility for the marginal cutoff grade, once capital has been paid back, et cetera, to for something to have a prospect of extraction? So resources, like measured in, it doesn't matter what category they're in, the concept of a resource estimate, yes, it's pit constrained, but the math that goes into that pit constraining is not, to keep it simple, it doesn't include the impacts of capital. So there isn't really this return on investment concept. It's just marginal math. It's like, what's a reasonable cost to move a ton of dirt from here to here, and is there enough metal in it that under reasonable assumptions, B is greater than A, kind of thing. So you use a lower cutoff grade for resources, and then for reserves, or even in a PEA, you can't use the word reserves for that, but the concept of any of these things is the same. It's like a full the full soup to nuts economic analysis that includes capex and all these things. And so the net result is that in our situation, which is quite simple, you just got one big pit. We're not dealing with different zones and underground or anything like that. You just have one large blob of a resource and a big pit around it. And so the net impact of this is that the resource pit will be bigger and deeper, and the reserve, or in our case, the PEA pit that produces a mineable inventory, is going to be a smaller a shell, like a smaller shell of that. So within our PEA pit shell, there was 978 million tons. So that shape is not, it's not just some floating cone. It's not some random thing. It's like a fully engineered concept that takes into consideration topography, geotechnical parameters, et cetera. There's lots that goes into it. So it's an engineered shape. And so that PEA pit shape had a mineable inventory of 978 million tons. And the proportion of that was measured and indicated is 80%. So when we think about inferred conversion, it's like assuming the PEA pit shell is a good bogey for a reserve pit shell, like the PFS mineable shape. They're not going to be the same, of course, but just for the sake of argument, assuming that's a good proxy for it, what you want to know is that 20% that was in the PEA that would now have to fall out of it. How much of that do you want to convert? So we're not necessarily interested in converting deep inferred resources that are nowhere near the marginal pit for a reserve. It's mostly about the stuff that's already in there. So the inferred resources that's in the engineered pit shape that, if we changed nothing, would have to come out of the PFS mine plan. It's about converting that stuff. So for what it's worth, we've done a lot of that already. Like we've had 2 seasons of drilling, probably 8,000 meters roughly of drilling over the last 2 field seasons, much of which has targeted or passed through inferred blocks. So we've accomplished a lot of the task already, but yeah, there's always more to do. So for the field season this year, it's not the last remaining priority, but it's sort of one of the key things that we want to do is, just have we have a clearer sense. Like what we know today is what the block model looks like with the benefit of those 2 years of drilling after our last resource. And what we're trying to, I guess, answer this year is, what remaining inferred blocks do we want to convert that are worth investing that money in today at our considerable cost of capital?
You're also, you've also done some metallurgy already. You've got, you had some metallurgy news recently with good news where you're going to 93% recovery. So big upgrade, sounds very good. But how thinly would you have to grind it to get that across the whole deposit, I suppose, to take it out, to get those recoveries to 93%? And would that be adding any capex?
So I think most of the network, both ourselves and the historical terrain stuff that we mentioned, pretty consistently pointed to a grind size of 160 microns, 80% passing 160 microns. And so, I don't think that's not a standout. It doesn't rate as particularly coarse or particularly fine. It's kind of pretty ordinary, I think. And there is a bit of there's a bit of regrind requirements. Once you float the con, the bulk con, and we have to do moly separation. So you don't have to, but it performs better when you do a regrind. But again, you're talking about much smaller volumes of material there, so that's not a large incremental OPEX cost. So when people think about comminution and its impact on capex and operating costs, like a lot of it has to do with its power. It's where a bunch of the power is consumed. So you're talking about big ticket items around the SAG mills themselves, and then big ticket items around how do you deliver sufficient electricity to site, and then once you have that, what's the kind of annual cost there? Again, none of these things are like standouts for us in terms of, we're not talking about the world's largest milling operation here. It's pretty It's smaller than both Gibraltar and Highland Valley. Again, we may choose to go larger, but all these things are small in comparison to a lot of the mines in South America, copper mines. Again, you got to benchmark it against copper mines. These aren't gold mines. They're not like 1,000 ton a day gold mills. These are big mines. So but from that perspective, there's nothing particularly outlierish of what we're doing there. We did an interesting study this year with BC Hydro, or with partnership from BC Hydro, looking at the amenability of HPGR. And HPGR is it's like an emerging technology. It's in commercial use in like a number of high profile mines. So I don't want to give people the impression that it's like experimental. It's not. It's like well established in cases where the ore is appropriate for it, and it's just a more efficient delivery mechanism of grinding power to the like rock surfaces that you're trying to fracture. And so in cases where the rock responds well to it, you just end up being able to, you don't need to have like, you're not losing power to like, just heat and random kinetic energy of rocks tumbling around in a mill. It's like there's just more direct conversion of electric power going into these rollers, being transmitted into the fracture surfaces, or the rock that you're trying to break. And so the real angle there that people should be aware of is really just around power capacity in that region of BC and the outlook for it in 5 years from now. There's a lot of industry happening there, which is a good thing, right? It's good for people to know that in our district, TC Energy built the Coastal GasLink pipeline, and a consortium led by Shell Canada built the LNG Canada terminal. I think it's a combined investment of like $40 billion, which is one of the biggest private sector investments in Canadian history, happening kind of right in our area. So again, it's a good thing that there's like, we're in a heavy industry area. This isn't like a frontier part of the country in that regard. But the corollary to that is lots of people want power, right? Everyone's looking for power. There's a lot of residential growth in the area. I understand you're going to Smithers later this year, so you'll see a bit of that. But there's lots of folks in the area needing power down the road, and so BC Hydro is like really interested in like future planning for that. We're not ahead on anything like that, but it's a competitive environment. Like we will want to make sure that we're advancing things, and that the Berg project is figuring prominently, provincially and with other planning professionals in terms of its competition for power. But on the same token, as part of the critical minerals strategy, provincially and federally, problems like this are being identified and addressed right now. So there's like money being deployed from some of these critical minerals infrastructure fund type pools of capital to just get right after this stuff, like build transmission lines up into the Golden Triangle that will unlock critical minerals development. So it's entirely possible that if the country recognizes these sorts of things as a whole, that these issues will just be solved with shared infrastructure and these kind of dedicated pools of capital. But again, I want to emphasize that I'm not at all saying this is like a big risk for the Berg project. It's not. We've got a few different ways to tie into the grid around us, and there's ample capacity today. But I will say that the sizing of the project is we're like, we couldn't just decide willy-nilly to double the throughput, because then power might be more of a pressing issue.
But talk to me maybe more about that. I mean, permitting a long LOM asset in BC nowadays, though, because BC's EA process moved to sort of what they call values-based model since your PEA in 2023. So what new requirements could that mean for you? Any additional work, any additional timing? What would that mean for you?
Yeah. Look, I mean, the EA process is it's very thorough. I mean, I think there's some rhetoric around like one project, one assessment or whatever the lingo is they're using for that. I think in practice that doesn't really matter for a project like Berg because you would have delegation anyways to the province with of course there's oversight and there's like there is um, historically there would have been like veto authority and stuff like that from the Fed. So we'll maybe see things like that achieve a different level of clarity. But I think um, the concept of permitting or taking a big project like this through assessment in BC today, and reflecting on this isn't like written down anywhere, but it's just kind of like what people see as the best practices and the kind of direction of travel for things. It's going to involve lots of different ministries feeding into the EA office, and a lot of involvement from Indigenous nations. So like a lot of our First Nation stakeholders. So there's this kind of evolving concept of Indigenous led assessments, and there's different meanings of that term. But the general concept is, rather than just a private sector proponent completely delegating, the consultation responsibilities to the government and just sort of sitting back and waiting for that outcome, which I mean, frankly, doesn't sound like a good way to do things. I don't think that's how anyone would just wake up and choose to do things today. I think the kind of policy world is evolving more towards private sector proponents should be involved with their local stakeholders from day one, and then kind of come to the table as a group and have lots of different like systems in place to formally capture those different stakeholder groups views on impact, and all that will kind of culminate into different chapters of an assessment or different kind of separate documents, what have you. That's kind of more about practical implementation. But yeah, like it's not something to be minimized. Like it's very complex. It can be very expensive. There can be a lot of duplication of efforts, which then speaks to why the government is talking about enabling policies to help expedite this. And so there's this controversial, or quote unquote controversial bill in the province, Bill 15, that was put forward and very quickly voted on and became law like a month ago. It's called the Infrastructure Act, and it vests sort of certain powers with a newly created ministry called the Ministry of Infrastructure, and the province more broadly to sort of designate certain projects as being, designated projects, like strategically important projects, whereby there will be as yet undetermined, protocols for the government to try to like remove duplication and whatever things they view as being some of the redundant causes of excessively long permitting timelines. And again, I don't pretend that the stuff is all figured out. I don't think it is. I think it's kind of establishing a goal. But they've talked about, let's try to, for things where it makes sense, let's try to reduce this to 2 to 3 years as opposed to 10. And so what criteria need to be met by projects to have that opportunity? Obviously, they have to be like this all kind of, it's not explicitly tied to critical minerals, of course. In fact, the Infrastructure Act doesn't even mention the word mining. It's all about kind of schools and hospitals and stuff. But, it is meant to involve kind of any infrastructure thing that's deemed infrastructure. So I think from a mining perspective, it's like assets that are that have that critical minerals lens are big. I think bigness is a driver here. It needs to be like impactful, and it obviously needs to kind of like meet the appropriate technical standards from environmental assessment. That goes without saying. So I think there needs to be a clear prospect for that, and a lot of work done leading up to it to sort of show that that's not going to be a stumbling block. And then and the same thing on sort of quote unquote consent or like consultation. So I don't think First Nations are going to be just doling out their consent for things preemptively. It's a big undertaking, and there's a lot to that. But I think what the government is trying to say is like, if a private sector proponent comes with a project and based on the work that they've done with their local stakeholders, there is a really kind of solid path for all parties to be in agreement and for the project to, deliver outcomes that achieve reconciliation goals as well, then those types of projects are going to be the ones that, potentially benefit from this as yet untested brand new legislation about trying to accelerate permitting timelines. So, I can't emphasize enough. It's like this stuff is not, it's untested. The laws themselves don't go into like fine detail about it, and it's like not just BC. Other provinces have put forward very similar legislation recently, and the federal government of Canada is as well. So it's clearly a kind of a coordinated effort that is, I think, tying into Canada's objectives across trade independence, across critical minerals and their role in all of that stuff, whether you're talking about energy transition or, maintaining our role in certain key industries, and reconciliation as well, right? Indigenous reconciliation is a fundamentally important thing here in Canada, and I think the government, almost irrespective of what party you're talking about, has been trying to harmonize efforts across these different threads in recent years.
Another thing that's critical to any projects, but especially in BC, is your relationships with the First Nations. I think you're dealing with 3 groups in total?
Yeah, at a high level. I mean, it gets basically.
What is your relationship with them? Do you have anything that you still have to get signed in order to move forward?
Yeah, sure. So I would I would say that it's not the way it maybe was 20 years ago, where there was like at the risk of oversimplifying, and I think some projects maybe or industry operators years ago might have had an attitude of like, try to get an IBA in place, and then that's your obligations, and you move on from there. Maybe people would disagree with that, but I think the best practices now are more like First Nations are your life of project long or even longer local stakeholders, and they should be involved at kind of every part of the project, and there should be there's impacts, and there should be benefits that are configured with that. So for us, we're not thinking about it as like, oh, we got to get to some next agreement milestone. It's like we as a company and as a project are gearing up for this EA process, which is like a big undertaking, and we're focused on ensuring that these partners of ours have the capacity to be involved in that, and are involved, right? Are feeling involved and all that. So as to whether you put a specific agreement in place that has a certain name for it and like what the terms of it are, I think at this stage it's not that's kind of mechanics. Like we have engagement agreements in place with them today, or communication engagement agreements that are appropriate for an exploration stage company. It's basically like good faith efforts on both parts. There's some capacity funding there, but if we're going to be asking these groups to be involved in an assessment, that's a higher level of commitment from everyone, and so it is, I think, natural to want to have more evolved agreements that aren't necessarily IBAs, because we don't like IBAs have to encapsulate what you learn through the EA process and the feasibility process. So like we're not there yet. So there's like kind of an intermediate step that is all about how are we going to work together through assessment. So I think that's what we'd like to do in the near term. But suffice to say, I mean, I think our relationships with them are very constructive and positive. And again, they are. It's not to be expected, especially in our situation where we have multiple groups. It's not like the Taltan where it's kind of one group. So it's not to be expected that they're going to early on preemptively sort of state their position on stuff, because I think that's they want to, they should be involved in kind of the whole journey and learning process. So but we've got a lot of collaborative efforts underway with them, and for the most part, like a 15-year positive track record, positive sort of relationship with each of these groups across multiple generations of elected chief and council and things like that. So agreements in good standing, things like that.
A couple of quick ones, Leif, before I let you go, because I know that you almost have to go here now. Marketing. I mentioned it at the beginning in my overview. Your marketing expense relative to drilling expenses is so your drilling expense about 12 times your marketing expenses, which is something I check for. I obviously want the company to be putting more money into the ground than in having the ability to shout off rooftops. But I still do want some marketing in the company. So what are you planning for marketing? Are you going to increase that spend? And then what are you going to be spending it on?
I think so. Again, for those ratios or whatever, I mean, folks can look at a longer time series. I think I enjoyed one of your recent videos that was kind of a amalgamation of a bunch of conversations you had with folks at a conference about their opinions on marketing, which 30 minutes of feedback from a dozen or more people. Everyone seemed to have a strong opinion, but there was like no consensus in opinions, which I found interesting. There was, I mean, maybe you could argue there was consensus, but it was, it was like sort of people had fixed numbers or percentages of G&A or percentages of like total spend. So I think in the surge case, again, if you looked at like a running average over 5 years, I think that we're on the very low end in terms of marketing. And in fact, I've noticed that is a source of criticism. Like it probably usually goes the other way around, where people, market participants, sort of gripe about some junior mining companies overspending here. And I've occasionally noticed people saying, hey, this company should do more of that, and which is interesting. Like I think I don't know what the number is. I mean, it's for us, it's been. I mean, I'd probably go about it more on like the fixed dollar amount as opposed to like percentage of annual budget. But I think we are, if I was spending a few $100,000 a year on marketing, that would be a big year, right? So it's usually been quite a bit less, and a lot of it is just like that doesn't mean that there's less marketing. It's just a lot of it is just me doing it. It's like the cost of having me in the seat should be amortized across those efforts as well. But a lot of it is just sort of me on meetings like this, leveraging my network across the world to sort of tell the story. But in terms of more bespoke, more what people would think of as marketing, whether it's these sorts of very unique interviews or video production or conferences, things like that. I think as we approach pre-feasibility study, I want to do a lot more of it. I think, as I alluded to earlier, I feel that from my vantage point, the intrinsic value of Surge on a per share basis has increased steadily and significantly over 5 years, and the share price has not. And so it stands to reason that like I have a lot more confidence and conviction in telling the story now to people of like, here's what we have, here's what we've delivered. Like you should really pay attention. And so that's not just, marketing isn't just to equity investors, it's to all market participants. And And so government is part of that as well. There's a lot of change happening in Canada, and I think elevating our profile with a wide range of stakeholders in terms of who we are, achieved, what we're doing, who our partners are. It's going to be increasingly important as we approach pre-feasibility study and look to that kind of permitting path. So yeah, I expect to sort of be in front of people digitally or physically a lot more in the next 12 months, I'd say.
What keeps you up at night? I understand you're here to present a bullish story, but nothing's really ever perfect. So what is it for you? What keeps you up at night?
Yeah, the stuff that like you can't control, and I mean the number one thing is like market valuation. Like it drives me nuts that that in the waters that we are fishing in, or that we're whatever the segment of the market that we're participating in, junior copper type stuff. We're like a sub $50 million market cap company. Like I feel strongly that the efficiency of this market is very low. For obvious reasons. There just isn't a lot of like funds flowing around where investors are doing the work that I am thinking of, which is like, hey, size these things up on an apples to apples basis, and pick the cheap ones and rotate capital around. Like that just isn't happening, right? Like I've often expressed this to some of my partners as, if you look at the Venn diagrams of shareholder registers across a lot of our peers, there's actually very little overlap. So like a lot of these things are just like islands of different shareholder groups that like they don't have a lot of cross ownership. And so therefore a lot of the people involved in these things are just not doing the same homework as maybe I would be doing on like, why is this one valued 10 times this one, right? So it's those sorts of things that are probably the biggest challenge, because like, yeah, if we have a technical hurdle, we can get a bunch of people on it thinking really hard, coming up with creative solutions, and getting a win, getting a good outcome that we're happy with. With like capital markets and just the market, you can't do that, right? Like I don't just like turn a dial to make our cost of capital go to a certain level. And I think we've had we've to the extent you can, like, securing strategic investment, for example, like those are things that should improve that, but we've seen only moderate impact from it. So those are the types of things. I don't know if it's a great answer for your question, but like frankly, I am not kept up at night by, political risk in Canada or technical risk for the project or things like that. I think we're in a very good position with regard to those things. For me, it's a lot about when will the market start functioning well for not just Surge, but junior mining in general. It's been a very hard several years, and these are very strange markets. And just to put maybe a final point on that, it's like I feel like doing something in the kind of critical minerals space right now is like every politician in the world is talking about it. It's like a top news item. It's like it's the most thematically relevant thing you can be doing, and yet the equity markets like are just not there, right? It just doesn't. So it's a strange juxtaposition. There's good reasons for it. I mean, there just isn't a lot of like assets under management earmarked for this stuff. And the average kind of consumer household in the country here is not throwing a bunch of speculative capital around. So there's good economic reasons for it, but it's just a funny juxtaposition that you have a really really topical world political important thing going on around critical minerals, and for a lot of these companies, not just us but just across the map, it's like it's hard to get attention. It's hard to raise capital. I mean, we've done well, but very hard for some groups out there.
It's true. It's again another topic that we could possibly do a whole podcast on. I know you have to go now, though. Leif, what am I forgetting to ask you here? What did you come here hoping to talk about that I've not brought up? Again, I think a lot So I think a follow-up conversation might be worth it. But what's important for now?
Man, I think we've covered a lot of stuff, and I've really appreciate the opportunity to get into some of the details on the strategic thinking. Apologies for my long-winded answers, but it's been a pleasure to be able to talk to you about that. Look, I don't think we're missing anything. I know you've had a few interesting conversations with some other companies about how they think about financing and raising money, and I hope I can talk to you about that in the future too, because I think we've done some great stuff there, and I think we take a unique approach to it. And I often find that the market doesn't always understand, especially the retail market doesn't always understand how these capital raisings work. And so maybe in a future conversation we can dive into some of that.
It'd be great. I'd also have a couple of technical questions and stuff like that. So it'd be great to dive into more the metallurgy and the type of deposit you're dealing with. We didn't touch upon the molybdenum stuff as well, because it is a big part of your project there. So hopefully follow-up conversation sometime soon. And for people listening, they also get to send in their questions if they think we missed something. But again, Leif, I really appreciate your time. Thank you for going so much in depth, and hopefully speak again soon.
Likewise. Thanks very much. Talk to you soon.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company-specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing, and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Oh, so unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find a company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."